That is a heightened risk, and whether we get that or not, I think depends on things we need to watch, like the yield curve, of course, a nearly flawless indicator of what the economic outlook looks like. But I also like to watch the gap between the unemployment rate and the inflation rate here in the U.S. Those two have met at the same number ahead of the last three recessions. They're not there yet. There's still a little bit of a gap there. So I think this rally we've seen in January may have a little bit more legs, but could ultimately run into some pressure ahead of this heightened risk of recession, perhaps later this year or even in 2020.
You think it could be a negative year for the equity market this year, Jeff?
You know, it's possible. Again, we'd have to see. The Fed has stepped back a little bit here. There are some things in the near term that could continue to go right. We could get a break in the trade war, the U.S.-China battle back and forth. We could even see a tax war that will be positive for growth. You've got countries like Canada, Australia, the Netherlands, China, the U.K., and Germany all looking to follow the U.S.'s lead and cut corporate taxes this year. That could be a short-term boost to growth and profits, but that's all contingent on all that stuff getting done. And in the meantime, economic momentum does continue to slow.
Do you think there's a chance that happens, that Canada or Germany or whatever does cut their corporate tax rate?
I think there's a good chance. I just don't know if they can get it done this year. That's the plan, but it may actually drag out into 2020 when it's maybe needed. Remember, there are a number of countries that actually have some fiscal room to move. Germany's one of those. It's running a budget surplus right now. Each time it's done that in the past 20 years, it was followed by corporate tax cuts. Germany didn't need to do it in the last couple of years. Now, with nearly slowing into a recession in the last 6 months, it's time.
Now, why would we care, U.S. equity investors, if Germany or someplace else cut their corporate tax rate? How would it impact our markets?
Well, a couple of different ways. One is that it could simply boost global growth as you get a lower tax rate. More companies may be interested in doing more investment. Their after-tax return on capital investment may be higher, and that could be a plus. But this could also spill over into individual tax cuts as well, further bolstering the consumer, which, as we know, is the biggest driver of the global economy.
And what would be the best case scenario for the U.S. equity markets this year, Jeff?
It's hard to say. It's difficult to see valuations move a lot higher from here, given somewhat sluggish earnings growth. I think you'd need to see a very sharp turnaround in earnings. So we're looking at, this year maybe modest single-digit gains, but also risk of losses this year. There's maybe more risk to the downside than the upside. I hate to say it, but I think that's the case, and that means more defensive positions in sectors like healthcare, where earnings may be less vulnerable to an earnings recession, as you mentioned, maybe a more attractive place to be.
Listen, what you say is important because a lot of your, you got millions, millions of clients at Schwab that it may take action on what you say. So if they believe what you're saying, they're a little more concerned. Do they just put their money in healthcare and let it ride, or are there other parts that look attractive, even what may be a muddled overall scenario?
I think global diversification is really important this year. Last year, the U.S. outperformed, and it may seem in difficult times to retrench to what you know, to focus just within the borders of the U.S. But as I mentioned, from a tax cut perspective or even a relative growth perspective, there could be opportunities outside the U.S. that may offer growth or even may offer some diversification from what could be an overall very volatile year. So I'd think about global diversification this year as very important in equities. However, I'd be a bit cautious on emerging markets. They have had a nice rally here, but they are vulnerable to a number of pressures, particularly slowing global economic growth. You might want to lighten up there, focus a bit more on the developed markets.